Hey, future millionaires, this is MK, and welcome back to Trade and Voyage with MK. In this powerful lesson, we are diving into something retail traders are never taught: how institutional traders manipulate the market and how you can finally beat the game by understanding the ICT concept. Have you ever wondered why price always hits your stop loss before going your way? This is not bad luck, it's by design, a design created by institutional traders who understand where your orders are. Today's lesson is the start of powerful series that teaches you to the trade with institutions, not against them. If you haven't watched previous lessons, check the technical analysis playlist in the description below. Let us dive into after intro and disclaimer. What is today's lesson agenda? Why most retail traders fail? What are ICT concepts and why they matter? Liquidity, stop hunts and smart money, premium and discount zones, ICT tools overview, live gold case study, mindset shift, and what is next. Why most retail traders lose? Rely on indicators over price behavior. Get caught in the stop hunts and fake breakouts. Don't understand liquidity based movement. Problem: price grabs stop loss then reverses. I will show you the example in the chart. This is gold 1 minute chart. It is in a replay mode. I will play it. Okay. So it look like a real price chart. Okay, we got one high here because sing high is formed here. This is high we mark. When this high broke, we will take a break and retest trade. Okay, as normal retailer we will do that one. We can see how it is working. Or yeah, breakout happened. After breakout, what we will do, we will enter this trade here and our stop loss will be swing low and our target is 1 is to 2. We'll see 1 is to 2 we can put the target. Then what is happening? See, price came to our entry. Oh, we stopped out here. See, our stop loss hit. Then what is happening to the market? We'll see. Is going our reverse from there or will go to against our direction? We'll see. Our direction was correct. See, yeah, hit our target. Our prediction and everything was correct. We were in the buy side, but what happened? Our stop loss hit and we are out from the market and it's went. Why it is happening? There is a term engineering technology like liquidity. See here, this point will tell us in a liquidity area. See what happened? The institutional traders knows that one. Everyone means retail traders will put their stop loss here. So to their trigger all orders, what they happen? They made the low of this price, then grabbing the liquidity is always will fuel the market. So after the liquidity grab, it's went our direction. See what happened? If we didn't put your stop loss here, what will happen? We will hit, but we have to put stop loss always. So what is the matter for that one? How we have to do the trade? We have to wait for the first liquidity grab. Then only if you have to take care of any trade, we have to check if that liquidity happened. Then only you can avoid this kind of liquidity grab. Have you ever experienced this? Comment yes or no in the comment section. What are ICT concept? ICT, inner circle trader, a method that shows how institutional traders hunt liquidity, file large order efficiency, move market using imbalances. ICT is not a strategy, it is a mindset. It teaches you to read what big players are doing and position yourself with them. Once you understand this mechanism, the chart start making sense. We'll see how it is working and we'll show in the chart. You can see this is gold 1 minute chart. See, this is the low. Okay, as a retail traders, what will do when this low break? What will happen? They will take a trade from here, short trade. Okay, then they will put their stop loss here. Then they will target 1:2. But if you are an ICT concept, and ICT, if you know that one, if coming like this and seeing this one, will understand it's a liquidity grab. You can see from there, after the liquidity grab, what happened here, market structure shift happened here. Yeah, ICT concept, what they are treating, one should have one liquidity grab, then market structure shift here, minor market structure shift happened, and there is a imbalance also. This is imbalance here, and here also have imbalance that already filled. So here the imbalance, then what happened, it's moving to our direction. What is imbalance, we will see. This is known as a fair value gap imbalance. You can see this is the first candle. If one candle, then second and third, if there is any gap between 1 and candle number 3, that is area known as a fair value gap. If you mark the high of this one and mark of third candle low, then you will understand that. See how I mark the high of this candle, candle number 1, and low of candle number 3. You can see there is a clear gap between there, this high and this one. This is known as a fair value gap and showing that imbalances. But is why it is happening? There is a large number of orders were executing this place, so there is any imbalance will come. And what is the logic behind of when price moves from here, and it will work as a rubber band, price will come to this area in later time. We'll see if there is any area you can show in the, yeah, here you can see this is a candle number 1, this candle number 2 and 3, and here also we have two fair value gaps. Here is candle number 1, 2, 3. Here you can mark one fair value gap here, and another one is here. You see, 1 candle number 2, candle number 3. See, if you mark here, yeah, when price go, then coming here from price is pushing higher from this area, that is known as a fair value gap. You can see another example here also. We can see here, you can see here what happened when price going down. What happened, this is a candle number 1, 2, 3, and if it is in the downtrend, the low of candle number 1 and high of candle number 3. See, there is a clear gap. What happened when price come to this area, there is a large push from this price. This is why known as institutional traders. Here a retailer cannot make this much move from this zone or area. So identifying fair value gaps and trade accordingly will you give the most higher chance to the winning trade. You can see many fair value gaps in the chart, but you have to identify which fair value gap will work. That we will discuss later. This is a simple example of the fair value gap. How will identify fair value gap? You can see when you see the chart, you have to able to mark like this fair value gaps. You can see candle number 1 is candle number 1. See, this is the candle number 2 and this is the candle number 3. Okay, then low of candle number 1 and high of candle number 3. There is a clear gap. Okay, if there is a clear gap in between, we can mark as a rectangle or anything. This is known as a fair value gap. Actually, what will happen when price come this area, there will be reaction in the future. You see, it didn't come exactly, it's near to the fair value gap. Yeah, return from here. It will happen every time. You can see another example of here. I will remove all the drawings. Okay, this is the candle number 1 and candle number 3. You see, this is the fair value gap. Once price come to fair value gap, what is going to happen? See, pushing the lower price. And where we can another target, you can aim to the target to the another fair value gap. This is all known as internal liquidity. What are the liquidity we will study also in the later. I will show you another also example of fair value gaps. You can see there is no gap here. Yeah, it's a fair value gap. There was a fair value gap here. Okay, then here also have fair value gap. You can easily simply identify this one. This all fair value gap known as imbalance. What is happening? One movement, then another impulsive movement. Third candle, how movement, and they are not connecting to the any wick or any body size of the candle number one. That means there is a clear gap. It is known as a fair value gap. Here also fair value gap. So we can identify fair value gap in your chart everywhere. You can see here what happened after this move. Yeah, there is a clear fair value gap. After the fair value gap, what is happening? When price come to there, it's moving from there and making another fair value gap here. See, then it's coming to the this fair value gap and going. Here also you can see fair value gap. This all known as a fair value gap, FVG, fair value gaps. Or FVG. Okay. Institutional manipulation. Liquidity pools. Areas where many stop losses are sitting. Stop hunts. Price intentionally moving to grab liquidity before reversal. Smart money. Institutions manipulating price to enter the at the best level. For an example, if supports get broken, everyone shorts and price reverses and shoots up from that area and retail loss smart money wins. You can check the chart and how it is working. You can see the real examples of star that one. You can see we have some resistance area here. Okay, and this is our support area. We can see how price reacting to this area will price will play. If coming to the resistance area, what will if any breakout happen, what is retailer will do after the breakout? Retest and we will take the long trade. And if here support broken, we will take the short trade from here. We'll see how it is working in the market and how the retail traders getting trapped. See, from here market shot up, there's no breakout happen. Okay, now it is in the resistance area. We'll see. Yeah, now breakout happen. So as a retail trader, what we will do, we will take a trade from here. We'll put our stop loss here and target 1:2. You have to understand the logic behind of this one. Then after that you will, whenever you see the chart, you will never get a fake out or breakout like this. See what is happening. Yeah, we get entry and yeah, it's moving to our area. Fair. See, look like a real breakout, right? Then it's retesting, everything happening. This is all manipulating by the institutional traders. See, after that what is happening? Price coming, drastic price dropping from drastically from here, this area. So how this logic here? See, the institutions are getting liquidity from here. They grab this liquidity. After this one, yeah, they got many orders from here and then grabbing that liquidity. Then they know that one, all their stop loss will be here. So grabbing that one, they are getting their orders are filled, grabbing this liquidity. You can see then price reacting like this. We can check another area also. We'll see. We'll stop. We can understand in the chart. We can check many area it is happening. It's happened here. You can see here also. It's also came to the our resistance area. like breakout happening but immediately reversing. It's known as a fake breakout or liquidity grab. You can see everywhere, you can see that one liquidity grab. You can see what is will happen here. You're thinking that support was broken, but immediately reverse from here. If you take the trade from here, what is happening? And put in stop loss, immediately grabbing your stop loss. So every support is broken, it must means it's not real breakout. It's like making the liquidity for the retail traders. So whenever you enter, you don't want to be liquidity for that one. So you have to think like an institutional trader. So wait for the liquidity grab. Then after that, if you're getting good structure, then you can enter. You can check the another area also. You can see from here. Here it's reverse from here. After taking the liquidity, it will be reverse. So you can see here. After this breakout, if you enter the trade here, enter the trade, and if you put the stop loss exactly low of this one, what is happening? Then price move come here, then exactly taking from here your stop out from here, then price move to your direction where you want to go, same direction it is going from there. So what is happening here? They got the liquidity because you are entering early. You have to wait for the liquidity grab. See, after the liquidity grab you enter, then you will get the move to the institutional movement. They understand where is the stop loss and they are grabbing that one, then moving to the way they want to go. You can see here is come here. This is the liquidity area. You can see grabbing the liquidity here. Then what happened? Going to the opposite direction. If you think this is upward breakout, you will enter the trade, then you will be trapped. So you have to understand the market structure always, then accordingly you have to trade. Then you have to think about before entering, am I going to be liquidity for the institutional traders? If you are feeling like that, don't enter to that trade. Understanding premium and discount zones. Discount zone, below equilibrium area to look buying opportunities. Premium zone, above equilibrium area to look for selling opportunities. Use Fibonacci 0.5 to 0.79 to mark this zone. Institutions buy low and sell high within this range. Trading outside of these zones increases your risk. Trading inside them give you institutional level confidence. Have you ever bought at the top of or sold at the bottom? Drop me in the comments. We'll see in the chart how to draw discount premium zones for a market. This is gold chart. Okay, when first we have to identify the market structure. What is the market structure here? Here you can see this low is broken, then these are the area. This was the low broken, then this is the high. This is our range. Then what is the new low made? And this one. Once new low made after breaking the structure, so we can mark this one and using the Fibonacci, or you can use the Gantt box, mark from the here to here. Okay, so this is known as a premium and discount zones. This area known as equilibrium level. This area, this point 0.5, we can say that equilibrium level. What we'll call this one? Equilibrium level. Okay, equilibrium level. Then the price below the equilibrium level we can call as a discount area. It is called as discount. This area what we call discount area, where we are looking for the buys. Okay, discount area we will look for the buys, and another area will tell that premium zone, premium area, where we have to look for the sell. Okay, so what happened after this one? Price came to the premium area, so from here we can sell. See, after the liquidity grab from here. So these are the two zones. I will mark it as like this. Premium zone we can mark it as, this is sell area, so we can put it red color. This is a premium area, and this is known as a discount area. When this, always you think that one, when below the equilibrium level discount area you have to buy, when price in the premium area you have to sell. What is here our market structure? Already showing that it is in the downtrend, so we are looking for the sell trade only. When we will look at the sell trade, it will when coming to the premium zone area. We will not sell here. You see here also market structure shift happening, like break of BOS is happening, but and here also BOS happening, but we will not sell here. Why? It is in the discount area. We will sell only once price come to our premium area. You see, after premium area what happened here? Made in a fair value gap, then change of character happened, then move to away from there. We'll check another area to show the how the discount and premium zone works. Here what is this one? Here where is the market shift happening? We can see here. Okay, here it is high happen here. Okay, it's high broken from here, then this is the low and this is the high. So when we mark from here to here to our golden box, you can see exactly from where it is reversing from our equilibrium area. It's coming just below the discount area, then moving from there. So that's known as a equilibrium area. It's a good area to buy 0.5 area. See, when market structure upturn, then it turns to bullish. What we have to do? We have to connect our low and high, then mark the premium zone or discount zone. Once price coming to the discount zone, we will buy. From here we will sell, but we cannot sell until here because it's already bullish. So we have looking for only buy. Even you are selling from here in the lower time, you can sell until to this area only, where the time frame equilibrium area only. If you want to go to the 1 minute, maybe you will have the chance there, but you can only sell up to the equilibrium area only. This can be see here. I will see, check where it is. It's 1 minute, so it will have more charts. Cannot see here. No, 1 minute chart is not showing there. So like that, you have to be think about the equilibrium and premium discount zones, so it will give you more chance for the winning. Once every time you can see, I will remove this one, this break, and this one came almost, it didn't come to the discount area from its move, but here you can see it break and it came to the discount area. After discount area is liquidity grab also happened. There is a fair value gap. You can see after this coming here, liquidity grab happened. There is a fair value gap. From that fair value gap, it's move. Simple, right? Like, you have to identify the market structure first, then check for the liquidity gap. Then if it is in the discount, this one you have to buy. Then from there, what is happening with the push, with making a fair value gap. See, once that price coming to that fair value gap, you are getting trade, you are in the trade, and you can put the stop loss. How the trade, this first movement itself got 1:10, but you just only look for the 1:2 or 1:3, enough. So we'll check another example. What happened here? Market was in the downtrend, it is high, this high was broken, this all internal structures. Okay, we will not take care of that one. After this one, this broken, where is a high? See, this is the, this came here, is broken, and it came to the area where there's a fair value gap. Also they made the fair value gap. From here there is a fair value gap happened, then again there was another fair value gap. You can see, yeah, there is a small fair value gap. From there it's push, price push. So if you understand the market structure, then you have to check the area, discount and premium zones, then check the price movement from that area particular. You don't want me to get trapped buying in the premium zone. What will happen if you are buying from the premium zone? What will happen? You will lose your trade and you have to pay more money to take that trade. So wait for the discount always and see what is the liquidity pool. Like as I mentioned earlier, after this break of structure or anything happen, there will be one low. So many retail traders will put the stop loss there. That is known as a liquidity grab. Okay, after liquidity grab, its price reverse from that level. This is known as a liquidity grab. So first concept, we are not telling detail now, just an introduction of that one. We will study about this one for each lesson. Upcoming lessons we will study about all this one. So next one is fair value gap. I already mentioned how it is fair value gap is produced after first candle, second and third candle. There will be gap in between candle number 1 and 3, then it is known as a fair value gap. Same like this. Here this is the candle number 1, here candle number 1, here 2, and candle number 3. So there is a gap in between candle number 1 and 3. This is known as a fair value gap. What is next one? Known as a market structure shift or break of structure. What is market structure shift means? You can see here it was a low break and this is the high here. Okay, this is the high. When you break this high, it's known as a market structure shift, MSS. We studied earlier about this one. You can check our previous lessons. We are clearly mentioned about this one, and here we will detail study in the next lesson is like ICT concept, market structure shift. Okay, so what happened here? Market structure happened when this high broken. What we will say is known as an BOS, break of structure. But we'll say this one BOS, break of structure. You can mark it as a break of structure. Okay, then another concept, what is that? Order block. What is order block? Nothing like institutional traders using this candle, there will be large push from that one. Okay, after here we can see opposite candle for this one, like when coming to the order block from bullish, it will be the opposite last candle. Okay, here downward close, that is the last candle. Here this is the last candle of the downward close. Then it's this candle known as an order block candle. You can see once price coming this candle, what is happening? It's a large push happening, so it is known as a order block candle. Okay, here you can see mentioned in the downward trend. You can see when price coming to this area, if there is a large push, means that is known as an order block. Here you can see, here see, this is the last downward candle, upward candle, but here you can see this candle grab this liquidity, so we can consider this candle as a order block. Don't mind the color. As my understanding, this is the best way to identifying the order block. You can see this one. So once price coming to this area, see price returning. So what you have to think, the last upward movement, this one is the last push to here upward. Then you can see here, this is a high, but this candle, that one grab the high of this one, so we will this consider as a last push candle. Okay, so after last push candle, when coming down and market structure shift up and everything happen and fair value is there, so this candle known as an our order block, bearish order block from here. Okay, once price coming to here and bearish order block and coming to the fair value gap, so of course it will be in a higher probability to enter the trade here. Why? There is an order block and fair value gap also happen. So once you enter here, you can see, can put the stop loss here high and target for the here also one for value, fair value, or the low of this one to get it up. If you considering this low, you see it's already getting 1:10. So like that you can identify the all this one order block, fair value gaps, market structure shift, break of structure. Live case study, smart money setup on gold. Walk through a real trade using liquidity pool, stop hunt, fair value gap formation, shift in market structure, entry within discount zone, targeting opposite order block. We'll see how it is working real. This is gold chart. We can go to the replay mode at any area. I'm not checking anything. Just we will randomly we will go to any area. We will identify our structure and place the order. Okay, we'll put it here. Okay, so here what is happening, we were in the downtrend. From here market structure shift happen here. Okay, when market structure shift happen, where is our low? Here, and we'll see this is our low and this is our high made. Once coming into the discount zone, we will try to get a trade if there is any chance. We'll see how it is working. I don't know how it is chart will come till like a real trade. Okay, so that high is broken means we have to make this as an high. We'll see, we will enter any trade once it's coming here only. Okay, it's again going high, means it's not coming to our premium zone. Yeah, we'll see. In discount, if it is coming in the discount zone only, we will take the trade for this one. We'll watch the movement. Okay, so here also what happened, here small break of structure happened. Actually here also we have the small zone here if you want. Yeah, this one is the high and this is the low. Once come to the discount zone, liquidity grab, you can see here we have fair value gap. We'll take the trade from fair value gap, put the low here, or just below the fair value gap. This is the fair value gap candles 1 and 3. You can put this low below the this candle, okay, and target 2. Exactly, it's work here. Same like you can, okay, now you can see this one. We'll remove this one. This is high broken, then we will see where is our new high. If it is, yeah, we got this high. How it is coming to the, we are seeing low and seeing high marking, one candle, one left low low and right also lower low, then it's our swing high. Once this swing high form, after this one we can mark our zone here. See, this is the low made for that one, and until there, then we'll wait for the price come to the discount area. If price coming discount area, and in discount area we will have the fair value gap here also, but we have to wait for the price come to this our area. If price coming to our area, then we'll see any upward movement from 0.5 itself. We can start. Yeah. What happens here, the discount area, this liquidity grab, this all probability we have to checklist our checklist. Then if it is happen, okay, we can enter the trade like this. Happen, I don't know what will happen, but we'll just put like this. I feel this is the liquidity grab, then we can opposite here or 2, 1:2. We'll see. Not at stop loss it. Yeah, not stop loss it. We'll see. Almost here came to the stop. Yeah, we hit the stop loss because we couldn't get the market. What happened here? Still we are in the uptrend. Okay, so we'll look for the up again. If there is any chance for up, we will look for the uptrend. Yeah, we got the one more here. You can see here also one more fair value gap. Only simply we are not looking any market structure, just how to trade with the using the fair value gap in the discount zone. Only this is the strategy for this one. Okay, once you are getting the any fair value gap in the discount zone, we'll take it. Now we are only looking for the buy because we are in the uptrend here. So yeah, we can see here we'll take the trade from here. 1 2 3, this is, we will put our stop loss here, and 1:2. We are in the trade already. Entry, we'll see. Once you reach 1:1, you can put to like break even, or just or keep the same. You can see this is also hit. So now what is happening, this is our still we are in this range only. Okay, so will not change anything unless break this high or this low. We are in this range only. Okay, we'll see how it is happening. If any check get gap and like fair value gap in this area, we can take. It's in the discount zone. Now it's actually discount zone. Yeah, it is. Now this one broken. Okay, so we'll remove this one. It's happened. Now where is our low broken? This is our low broken and this is high made. We'll see where is the swing low is making. If swing low made, we will mark it. Yeah, swing low made. So from here, now we'll for the looking for the sell trade if it is coming in the premium zone. Okay, once price come to the premium zone, we will see. No, didn't come our premium zone. It's made here low here. Okay, this is now our signal. We'll see. It's coming our premium zone. We need one liquidity grab. Yeah, now it's what happened. It's turned to the bullish, so we can looking for the buy trade if it is coming here. We'll see. Is coming to this our discount zone or not? Like price is going high, so this is high, this is the low, because here what happened, break of structure happened, then this is the low and high. Once low and high we got, we will just mark our premium and discount area. This like it is in the premium zone, we will not do anything because we need it is in the discount zone. Okay, yeah, because price once come here in the discount zone, we got one fair value gap here. Okay, yeah, and we can target our this only. Okay, so we'll see next fair value gap getting. Yeah, we got one fair value gap here. Okay, we can target until over here. We'll see how it is working. Hit our stop loss. Yeah, hit our stop loss. So what happened here? Still it is in the bullish. Okay, so liquidity grab happened, then again there's a fair value gap. We'll see this one. Okay, how it is working from this fair value gap. It didn't give the entry, it's went from here. See what happened, this liquidity grab happened, then after the fair value gap it's went straight away like this. So you can backtest from your chart how it is working, the premium zone, discount zone. So wait for that area, so don't enter the trade too early before the liquidity grab. Okay, mindset shift from retail to pro. Be okay with waiting. Institutions are patient. Stop following signals, start following structure. Less is more. One high quality trade is greater than 10 random ones. You don't need to catch every move, you need to understand why the move happens. Come in smart if you are ready to follow smart money only from now on. We can see the retail mindset. What is the retail mindset happen? Chase price after big moves. relies heavily on indicators, trades frequently with no plan, gets stopped out before the real move, trades emotionally, FOMO or revenge trades. What about the smart money mindset? They wait patiently for liquidity grabs, uses market structure and clean charts, execute only high probability setups, enter after stop hunt and confirmation, trade with logic, discipline and patience. Be a smart trader. Summary and what is next. What we covered today. Why you have been trapped as a retail trader. Introduction to ICT concept and smart money. Premium is discount zones. How to see through market manipulation. Gold case study using ICT. And next lesson, we will study about order blocks, identifying institutional activity on gold charts. Like, comment and subscribe to the continue mastering the market with the smart money blueprint. Thank you.